Today, we're diving into Union Pacific, a true cornerstone of the American economy. But right now, this industrial giant is at a massive fork in the road. It's making a single colossal bet that could redefine not just its own future, but the entire U.S. rail industry as we know it.
And when we say biggest, we mean it. For anyone invested in or watching this company, this is the story. Union Pacific is pushing all its chips in on a move that is both its single greatest opportunity and, well, its single greatest risk.
Okay, so to really understand the gamble they're taking, you first have to understand the core asset. I mean, what makes Union Pacific such a powerful business in the first place? It all starts with a physical steel in the ground.
Just look at the scale here. We are talking about a network that is, for all intents and purposes, completely irreplaceable. You couldn't build this today. The cost, the regulations, it's just impossible. But the real kicker, the thing you have to lock in your mind, is that last point. Union Pacific is the only railroad that serves all 6 major gateways to Mexico. Remember that, because it is absolutely central to where this story is going.
So if the network is the what, the next big question is the how, right? How does Union Pacific wring so much profit out of all that steel and track? For the past decade or so, the answer for the entire rail industry has been this one philosophy: precision scheduled railroading, or PSR. So what in the world is PSR? Well, think of it like this. It's about shifting a freight railroad from a kind of we'll leave when it's full model to a super strict passenger train-like schedule. Cars move on a disciplined timetable whether the train is completely full or not. The one and only goal is ruthless, relentless efficiency.
And it all boils down to these 3 things. It's about using fewer assets to get more work done. You run longer trains with fewer engines, you make sure those rail cars are always moving, not just sitting idle in a yard somewhere, and you become absolutely obsessed with your operating ratio. That's just your expenses as a percentage of your revenue. The lower that number, the better you're doing.
But PSR has a dark side. For shareholders, it was an absolute home run. It drove insane profits and incredible cash flow. For customers, though, it was a different story. By running everything so lean, it took all the slack out of the system. So when demand shot up in 2022 and 2023, the whole network became brittle. It basically broke down, and service was a mess. And it's that fragility that has everyone, management and the market, looking for the next big thing.
So you've squeezed every last drop of efficiency out of the system. Where do you go from there? Where does the next wave of real growth come from? Well, the company is now shifting its focus from just optimizing itself internally to capturing these huge opportunities happening out in the world.
And the biggest opportunity out there, by far, is this massive trend called nearshoring. Companies are moving their manufacturing out of Asia and setting up shop in Mexico. This is creating a tidal wave of new freight that needs to move across the border. And hey, remember that map? Union Pacific's exclusive access to all 6 border gateways puts it in the perfect position to capture this boom. For a lot of investors, this trend alone is a powerful reason to own UNP.
But as big as nearshoring is, that's more of an evolution. Union Pacific is aiming for a full-on revolution. And that brings us to the main event, the centerpiece of the whole investment case today, the transcontinental gamble.
And here it is. The proposal is to merge with their eastern counterpart, Norfolk Southern. Now, this isn't just about getting bigger. This is a move to create something that has literally never existed in American history, a single, seamless railroad network stretching from the Pacific Ocean all the way to the Atlantic.
The scale of this deal is, well, it's just immense. We're talking about an $85 billion price tag to buy Norfolk Southern. That is a truly company-defining number.
But the potential prize is just as massive. Management is projecting almost $3 billion in annual synergies by the 3rd year after the merger. That's the financial jackpot they are chasing.
And you have got to look at this breakdown. This is so important. Nearly 2/3 of that money is projected to come from new revenue growth, not just from cost cutting. This tells you everything. The deal is fundamentally a bet on growth, on creating a better service that can steal a ton of business away from the trucking industry.
So here's the core logic. It's not just about being bigger, it's about creating a superior product. By getting rid of the slow, expensive process of handing off cargo between different railroads in congested places like Chicago, they think they can offer a faster, more reliable, coast-to-coast service that trucks just can't beat on price for long-haul routes.
But here it is, the multi-billion-dollar question.
This entire grand vision depends completely on getting a thumbs up from a small but incredibly powerful regulatory agency in Washington, D.C. called the Surface Transportation Board.
And the hurdles here are incredibly high. The rules are so strict now that they don't just have to prove the merger won't hurt competition, they have to prove it actively improves it. That is a very high bar. They are facing a wall of opposition from their own customers, from unions, from rival railroads, and this review process is going to be a long, messy, uncertain fight that could easily last into 2027. Getting this approved is no sure thing. Not at all.
Okay, so with all that as context, let's bring it all back to the bottom line. If you're an investor looking at Union Pacific stock right now, what does all this actually mean?
Well, first, let's just remember the baseline. As a standalone company, Union Pacific is already a best-in-class performer. You can see their operating ratio is way better than their Eastern peers, including Norfolk Southern, the very company they want to buy. This just shows you how good they already are at running their business.
And this right here really frames the choice for shareholders perfectly. On its own, investors can expect the certainty of huge share buybacks. We're talking $4.5 billion next year. But if the merger goes through, those buybacks get put on hold so they can pay down all the new debt. So you're trading that near-term certainty for the potential of a much, much bigger prize, a $10 billion plus annual buyback program down the road.
So, what does Wall Street think? Well, the stock isn't trading at some crazy premium, and that tells you the market basically sees this as a coin flip. The price doesn't fully reflect the massive upside if the merger succeeds because that regulatory risk is just so high. For an investor, you can almost think of the stock as a call option on the deal getting approved.
And so that leaves us with the final, all-important question. When you buy Union Pacific today, what are you actually betting on? Are you betting on a fantastic, efficient, standalone railroad that has a great growth story tied to Mexico? Or are you making a high-stakes all-or-nothing gamble that regulators will approve a deal that could completely transform the company and really the entire map of American commerce forever? That's the decision the market is wrestling with right now.